Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's video, we're going to look at how to stress test your retirement portfolio using Monte Carlo simulation. And that sounds, for some of you, maybe like, what? But it's actually pretty straightforward. And I don't know, I actually think it's kind of fun, but whatever, I'm weird. All right, so this comes up from two questions I received from viewers. Let me read them to you briefly. First one comes from Jeremy. He says, hello, Rob. I have a portfolio visualizer question. That's the tool we're going to look at in a minute. I like to use Monte Carlo simulation based on statistical rather than historical returns to get a sense of if I'm on the right track for retirement planning. He uses a 90-10 portfolio, 90% stocks, 10% bonds. My question comes in with risk-adjusted returns. I want to get a sense on whether my portfolios will survive in possible downturns during retirement. Yeah, don't we all want to know that, right? Monte Carlo allows an option to add the worst year first, with it going up to actually the first 10 years being the worst. And again, I'll show you that in just a minute. Should I always plan for the worst case scenario or split the difference and say something like worst 3 or 5 years? Again, we'll look at that. That was the first email. The second one came from a viewer named Chris. Hi, Rob, just discovered your YouTube channel and love it. I've been planning for retirement for about 10 plus years, doing detailed Excel spreadsheets that run Monte Carlo analysis and determine my odds of success. Aside from the net worth of my accounts and an accurate estimate of expenses, the key inputs are returns and standard deviation, which is just the volatility, the variance of the returns. Using these two parameters, the Monte Carlo analysis will generate a random return for each year, which follows a normal distribution. It runs 1,000 simulations and comes up with a probability of not running out of money during my lifetime. I'm currently at about an 85% chance of success, and I'm retiring this year. I'm wondering if you think this method is sound or is it lacking in any way? So those are really good questions, and frankly, I had a lot of fun doing some research for this video. So let's just jump right in. This is the tool they're talking about, Portfolio Visualizer. It's a free tool. The way you get to the Monte Carlo simulation that you're seeing here on the screen, if you go to portfoliovisualizer.com, you're just going to scroll down to this Monte Carlo simulation section here. And we're using the first one that says Monte Carlo simulation. That takes you to this page. And you'll see some explanation of some of the terms that we'll see down here. You can also go to the FAQ section and you'll find more information. In fact, let me just do that briefly. You'll come here and it's down in methodology. Kind of can be a little tricky to find. And then we come down to Monte Carlo simulation. And trust me, you'll find more information here than you probably want. So if you want to dive into the details, you can do that there. So portfolio type, we're going to use asset classes. You could put your tickers of your investments in. We're going to start with just $1 million portfolio. We're going to withdraw a fixed amount periodically. We're starting at $45,000 a year, so that's a 4.5% initial withdrawal rate. We're going to adjust for inflation. So that's basically the Bill Bengen approach, right? You start with a set amount of money based on some withdrawal rate, in this case 4.5%, and then you adjust for inflation. We're going to withdraw annually for 30 years. We're going to use pre-tax. The only reason you would use after-tax, I think, is if most of your money's in Roth accounts, but you can test it with both. We're going to use a statistical return model, which is what the two viewers, their emails sort of asked about. You can use others like historical returns as well if you want to try out different approaches. We're going to use normal returns. We're going to use full history. In this case, the history will be used to determine the average returns and the standard deviation of the asset classes we're using. And if don't worry if those terms, if statistics wasn't your favorite subject, don't worry. The outcomes, I think, will make sense. We'll use historical inflation. We're going to rebalance annually. And so what I did was I created a 3-fund portfolio. I've got 50% in U.S. stocks, 20% in international, 30% in, I use 10-year treasuries. Could use a total bond market, but I use 10-year treasuries. you can obviously change this to whatever asset allocation you want. And when we run the simulation, here's what we get. So the first thing, these percentiles represent, like the 10th percentile would be if things didn't go well at all, you know. And so, and by the way, what this does is it runs, actually we can see a description here. It runs 5,000 simulations. So it takes, based on the asset classes we've entered, all the different outcomes that one could experience from good years to really awful years. Same thing with inflation. Sort of randomly runs those 5,000 scenarios. And in those scenarios where things really worked out in our favor, that would be over here, the 90th percentile. And you can see, boy, we could end up, we started with $1 million, we die with 17 million. That ain't bad, right? And that's in before you adjust for inflation, but even on an inflation adjusted basis, it's 8 million. On the other hand, if things don't go our way, this 10th percentile, we end up with a lot less. And this is just a graphic representation of the data we just looked at. And then here's kind of where we're going to spend some time today. Our chance of success. So in the early years, every single simulation, all 5,000 simulations were successful. What does that mean? In this case, it means we don't run out of money. All right, that's what success is. We don't run out of money. But keep that in mind. If you die with $1, that's success. All right. So as we move forward, we can see eventually some of the 5,000 simulations, not many of them, but some of them start to fail. And at year 30, what do we have here? 96.5% success rate. And that means a 3.5% failure rate. Now, one of the questions that was asked in the emails is this business about, well, should we assume that the first few years of retirement are really bad? Meaning stock market is down, inflation is high. That would be what bad would mean. And so we can do that, let's see, right here. In sequence of returns risk, we can say, okay, let's assume you do your random simulations, but one thing that won't be random is let's assume the first year is a bad year. And by bad, it's the worst. Worst, again, based on stock market losses or portfolio losses and inflation. And we can go all the way down to the 10 worst years, right? And so the question is, how should we think about this? And should we assume some bad years? That's question one. And then I think the second question is, how much success is enough? This is 96.5%. Is that good enough? What about 90? What about 80? And these are two related questions, because as we think about it, if we were to assume, let's say we'll just get crazy. We'll say the worst 10 years are at the beginning. Now, let's just think about that for a moment. What's that mean? Well, on a 30-year time period, we might have about 10 years of stock market losses. Well, what this means is we're going to put all 10 of those roughly losing years at the start of our retirement. Well, that's never happened. I think the most the S&P 500 has lost, I think it's been down 4 years in a row. I think that's the longest it's ever been down. And so I suppose it's possible it could be down 10 years in a row, but I think if we're planning for that kind of outcome, I mean, that's statistically almost impossible. I suppose it could happen though, right? And the 10 worst would also include the 10 highest years of inflation. So if we run that, as you might imagine, the results are going to get ugly. And we'll just scoot down to success. Look at that. Yeah, it's gone down to 22% success rate. And so the question becomes, well, how realistic is that? So here's what sort of a starting point for thinking through all of this. The first question is, how many bad years should we assume? 10 seems extreme to me. And should we assume any? I think if I were retiring today, I would look at the analysis assuming the first 1 to 5 years were the worst. Why would I do that? I might do that at any time, but I would definitely do it now in 2022. And I want to show you a couple of articles that explain why that's my view. And of course, I'll link to all of these articles, and I'm showing you below the video. The first one goes all the way back to 2008. It's actually a newsletter that Michael Kitces put out. And what he explored was this. He said, look, Bill Bengen gave us the 4% rule. And the 4% rule is based on basically the worst time to retire in the last 100 years, the late 60s. But there are times when, if you retired in the right year, a good year, you could have taken out 10% or more the first year. So what Michael Kitces was trying to do in this article is say, well, can we use stock market valuation, say using the CAPE, the 10-year cyclically adjusted PE ratio of the S&P 500, to get a rough idea of whether, are we in a 4% year where we've really got to, start at a low withdrawal rate, or maybe we're in a 10% year. We can start spending big in year one of retirement. Is there any way that we can know ahead of time? And what he concluded was that yes, that when there's good news and bad news here, by the way. The good news is, yes, we can kind of get a rough idea based on the CAPE, based on the PE, the valuation of stocks. And he has a chart that I will show you. We're going to scroll down here to... Let me see, he had a better chart, I think. Here it is. So what he found was when the PEs were high, and he was using the CAPE, so 19 to 28, you really had to start at a lower withdrawal rate, the lowest being 4.4. When the market wasn't doing well and the PEs were low, you could start at a higher rate. In fact, the highest rate, 10.6. So that's good news that we have some at least predictive indicator. What's the bad news? Well, the bad news is right now, as we all know, stock valuations are high. And the CAPE today, we can pull it up very quickly. The CAPE PE is, I think, around 32. So here's the CAPE PE right now. It's 32. It's down because the market's been down the last month or so. It's been higher, but only 2 other times. So if we go back to Michael Kitz's article, boy, we're beyond the upper end of the PE. So that's the bad news. We really probably need to think about a lower withdrawal rate, and because stock market valuations are high, we kind of need to be prepared for some kind of bad years, which gets me back to testing the worst years. I would probably go up to 5. I think, again, if you go beyond that, you can certainly. I'm just not sure the results are all that great. But here's another article that I want to show you. This is a interview that was with Bill Bingen. This was just a few months ago at the end of last year. And effectively, here's what he said. He said, Michael Kitz's work back in 2008 was fantastic, and it is predictive. It's not as predictive as it could be. However, if you add in inflation along with Michael Kitz's work using CAPE, you get really predictive. But that's the good news. Again, the bad news is when you add in high inflation rate with the current stock market valuations, well, you basically start to replicate a period like the late 60s where things get bad for retirees who are retiring now. And as we know, inflation is 8.5%. Now, what Bill Bingen said in the article is, look, the big unknown is this. Is inflation sticky? Are we going to have 8.5% or maybe higher inflation for the next decade, like we did through the 70s into the early 80s? That we don't know. However, we do know what inflation is now, and combined with stock market valuations, that is, frankly, a dangerous combination for folks retiring now. Now, by the way, if you're 85, you retired 20 years ago, it's different just because of life expectancies. The big concern is for folks that are just retiring now at 65 or certainly earlier if you're an early retiree. So given that, I really think it's prudent to test some scenarios where the first few years are bad. So let's do that now, and then we're going to finish the video with at least, I think, some good news. There is some good news in all of this. I promise you, kind of. All right, so we're back to the Monte Carlo analysis. Again, I think 10 years is a little excessive, so let's first start with just 1 year. How bad? And if the next year, 12 months are really bad, what does that do? And we're starting with a 4.5%. Remember, we're starting with a 4.5% withdrawal rate. And it does hurt us. Remember, we were at 96.5% success rate. Now we're at 93. So the end of the world? No, not at all. But even just having one really bad year to start your retirement still makes a big difference in the Monte Carlo analysis. Now, let's go up to 5 years. Obviously, you can try this on your own and go through all of them if you want. I'll just jump to 5 years. And we get a success rate that's all the way down to 57%. Now, if I were looking at this, I would not be too happy with that. Now, of course, the question becomes, this assumes 5 not really bad years in a row, which, by the way, I don't think has ever happened. We've certainly had 5 bad years of inflation, but we haven't had the 5 worst years of market returns in a row. So again, I suppose anything is possible, but you're looking at an outcome that is, I would say, statistically unlikely. However, I think there's even a better way. I said there was good news. Here's what I think is at least some good news. When we look at Monte Carlo analysis, one of the big questions is, well, what percentage of success do we need? What if I told you that there's a theory that says even 50% is okay? Here's why. We really shouldn't look at Monte Carlo analysis as, in this case, 57% chance of success. There's a different way to look at it. What we can say is there's a 57% chance we won't have to change our plan at all. And there's a 43% chance that we will. We will have to make a change. Because here's the deal. You're not going to run this analysis, pick a starting withdrawal rate, and then never look at it again. At least, I don't think so. At least I'm going to look at this at a minimum once a year. So every year I'm going to look at this Monte Carlo analysis for my own retirement. I might also look at it based on historical data. And what are we going to do? Well, we're going to make adjustments. If it turns out that we really do live over the next 5 years through a losing stock market and 8.5 or even more higher inflation, we're going to make adjustments along the way. So I think the right way to think about Monte Carlo analysis is not success versus failure, but I don't need to adjust my plan, or I won't need to adjust my plan, versus I will need to make some adjustments to my plan. Now, that makes an assumption. It makes an assumption that your starting withdrawal rate, in this case was $45,000 on a $1 million portfolio, you have some flexibility. If someone came to me and said, Rob, I need to spend $45,000, I can't survive on a nickel less than that on a $1 million portfolio, I think my opinion would be, yeah, you're probably not quite ready to retire yet. I think for most retirees doing this analysis, they have some wiggle room. They can make some adjustments. Maybe they forego an inflation adjustment for 1 or 2 years. Or maybe in a down market, they don't take any adjustment at all. They have the ability to make some adjustments. And with that mindset, there's actually some analysis that suggests a 50% chance of success is perhaps a reasonable approach. And let me show you that. Here's the article. It's on Michael Kitz's website. It wasn't written by him. It was written by a different planner. And he basically walks through, you can see it here, why 50% probability of success is actually a viable Monte Carlo retirement projection. Again, I'll leave a link to the article. And the interesting thing was, I'm going to show you a chart. But here's what he did. He said, let's compare 95% chance of success with a Monte Carlo simulation with 50%. Here's what we're going to do. We're going to assume with 95% that every month we run the analysis, and we're going to require a 95% chance of success. They weren't assuming the first 5 years were the worst, by the way. And at whatever that is, that's what we'll take out for the month, whatever allows us to achieve a 95% success rate. And we'll do that every month. So there's some variability. When the markets go down, you take out a little less. Same with inflation. When things are doing better, you take out a little more. And then he said, okay, we're going to run the same analysis, but we're going to assume a 50% chance of success. Now let's think about that. What's that mean? Well, it would mean in the first month of retirement, you could take out more money, right? Because you only need a 50% chance of success. But of course, if the market starts to go down, you could see some greater adjustments. Now, if you had asked me ahead of time, will these charts, how much money we could take out, from month to month, would they look different? I would think, well, of course they would. They'll look dramatically different. I mean, 95% chance of success versus 50? Come on. Well, let's take a look at the charts. And we're scrolling, and we're still scrolling. And I promise you it's here. So This is the first one. This is actually comparing 95% chance of success versus 70. Basically, these two different graphs, the green and yellow down here and the orange and blue, are kind of like, you can think of these as worst case and best case. But the point I want to make out is, we'll just use the top lines for now. The blue is 95% and the orange is 70%. There are some differences, but boy, not much. Now, if we go down to the 50% comparison, here it is. We're comparing, we'll open it up here. 50% to 95%. We'll just use the top line. They're remarkably consistent. What's interesting, by the way, is that you see some variability in the 60s. So by the way, the way to read this chart would be, if you retired in 1967, the most you would spend in any given month would be right here, which is about 9,000, and this would have been your worst month, right? But again, the real comparison is 50% versus 95%. This is where you see the most variability right through here, and it's because of inflation. It's not because stock market returns. We can go to 1929. Look, the Great Depression, I mean, the market crashed. It was terrible. Look, they're almost on top of each other. It's inflation is the killer. But still, even with that, over time, the difference between 50% and 95% probability of success, probably not as great as you would have guessed, certainly not as great as I would have guessed. But again, important to understand, they didn't just do this once at the start of retirement and then never looked at it again. They were doing this on a monthly basis and making the adjustments as they go. So where does that leave us? At the end of the day, I think Monte Carlo analysis is very important and a useful tool in understanding your retirement readiness. I think the probability of success, part of that depends on your flexibility. And if you have zero flexibility, I need every dime I can possibly get out of this portfolio, then I think the big question is, are you really ready for retirement? Again, you may be in a situation where you have no choice, but if you have the choice, maybe you're not ready for retirement. If you have flexibility, then I think the days of having 90 or 95% probability of success, probably not necessary, because you can make adjustments if things don't go your way. With Portfolio Visualizer, certainly you can test out to the 10 worst years. I'm not sure how practical that is. For me, given stock market valuations, given an 8.5% inflation rate, yeah, that's not good. But I'd probably think beyond about 5 years for me wouldn't be very helpful. But again, I really like the article that talks about how you can use Monte Carlo simulation, not just at the beginning of retirement, but throughout retirement to make those mid-course adjustments. They did it from month to month. That seems a little extreme to me. I might think of it on an annual basis, but of course you can take whatever approach you think is best. So there you go. I hope that helps. It's kind of how I think through Monte Carlo analysis. I really would recommend the articles that I mentioned. I'll link to them below the video. I think they're very useful. And again, Portfolio Visualizer is a wonderful free tool to use to do this analysis with. So there you go. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.